Hey everyone, welcome to the next session for the 2022 SOFA Summit. Really fired up for our upcoming speaker here. This is someone that we have been working with, wow, ever since before I even got started here with MIP and Reedy and Company, someone that we have had an incredible relationship for many years now. What is that, 7, 8 years? How long do you think
Got
that's
to be something like that. All I know is it feels like family when I go over to Memphis and come hang out with you guys.
Yeah, we love it. And so this upcoming speaker, his name's Aaron Chapman with Security National Mortgage Company. Aaron, welcome to the SOFA Summit.
Welcome. Well, I'm glad to be back, and I appreciate you guys letting me come back every year. And I say every time you've had the SOFA Summit, we've been here, and I've had the opportunity to speak in the office at the varied events you guys have had in other larger venues. Kind of sucks we had to go virtual for as long as we did, but it's kind of working out, right?
Yeah, it is. It's nice to be able to reach more people doing the SOFA Summit, but obviously the in-person, face-to-face connection is key. So that's why we always love get as many people down to Memphis, come hang out. We love that. So what I love about Aaron Chapman as just a human being and as a lender is he's the guy to go to when you want someone to deliver. If when you're buying a house, when you're buying a rental property, there's a lot of things that need to go correct, right? You need to make sure that you're buying a quality house that has a good home inspection. But when you want to actually get financing and take leverage, you want a lender that can actually deliver. And not all lenders are the same. And financing for a turnkey investor loan is very different than your primary owner occupant type loan. And we've had multiple situations where we got a call at what felt like the very last hour, and the individual investor said, I can't get this loan. I need to cancel the contract. And I say, do you still want the house? And they say, yes, I just need to figure out how to get financing. You give Aaron a call, boom, he'll pull some strings, and it's just like magic. He can get things done. So that's one of the reasons why he is our #1 top preferred lender on the list. He's the guy we recommend you go to, you reach out to get things done at the end of the day.
Well, I appreciate you saying that. And the string pulling that's being referenced there is interesting. Is like there's not like they're phantom strings. It's just the lending industry itself. There's things that's available to people to do that many banks choose not to do. What I mean, I'll just be honest. Even within our own organization of Security National, there's people that come to me a lot saying, how are you getting these done? Because we're having a hard time figuring out how to do these investor loans or these turnkey loans. And there's a lot of nuances to it that it's very difficult to understand. And the best way to get it is from the experience. And I've been doing this since 1997. I've been working with real estate investors buying turnkey since 2009. I've been working with investors strictly almost since 2003. Experience is what goes to that. And my team is large. I got 30 members of my team, and we're several hundred years of experience if you want to get and put all our time together. I've got people, I think the average person on my team has 15 to 20 years experience in the industry itself. But when it comes to working with real estate investors buying turnkeys, that right there is very different than anything else. And if you don't have a lot of time doing that, it can get you hurt. Now, there's a lot of lenders that will promise a lot of things, and God bless them for making the promises, but the promises that many of them make is the barrier to entry, right? You got to have a competitive rate. You got to have competitive costs. You got to be able to close the thing. That is a great pitch point, but it's also just the barrier to entry. To be able to handle turnkey investments, it's a different animal. And also working with a good team that understands how to deal with the real estate side of it is key. I've dealt with a lot of people where my experience can't help, right? I deal with people in certain areas of the country that it really just boils down to what they want for the client over themselves, or for the investor over themselves. If it's all about them, it's not going to work for anybody. They're not going to win because they're selfish and nobody wants to work with them. The investor's definitely not going to win because a lot of corners were cut. There's no way I'm going to win because I can't convince people to take care of people. I can only do what I know how to do, which is work with good people and give the best I can of us. So this year, we've talked a lot over the last few years. Those who have watched previous SOFA summits, we've talked a lot about what's going on in the market, what's driving interest rates. That's usually the common thing. And of course, that's still the conversation today. We're in a situation right now this year over last year. Rates were phenomenal last year. Then we have inflation going through the roof, and it had a major effect on how investors think. It's easy to think like an investor when the money's just laying on the ground for you to pick up. It's a whole different animal to think of as an investor when you have to actually think of it and you have to put your mind to what's going on. So what we have now is the cost of things, or less as far as the rate is concerned, and what's going on out there on the lending side is making people have to dig in and understand what is it that they are going to buy and why. Right, the cash flow is not as prevalent every month. So before, it was like, everybody was searching for what's house is going to give the greatest cash flow, and so they were caught up in trying to analyze that. Now they're trying to find something with cash flow. For me, what I tell them, quit looking at your P&L or your pro forma for the first year. Look out 3, 5, 7 years and see what is going to continue to perform and actually continue to perform higher. And that's going to depend on your ability to raise rents and the ability to buy a property that they'll stay reasonably rented for the entire time you own it. If you look at it from that perspective, you'll see how that is starts to pay off significantly. And the reason why, and I'll ask Mark to do a little bit of math for you, has a lot to do with, one, the market you're dealing with, who you're dealing with in that market that's helping you maintain your business. That's your operations division. Can you keep the property reasonably rented, and what can you raise the rents by? Mark, what's the rents increases year over year right now in Memphis?
The rent increases year over year in Memphis. So, I mean, we have been currently raising rents 10% which is absolutely unheard of. Raising rents 10% for the previous tenants that are trying to renew their lease. Now, that is on the higher side. That is not consistent and long term. Right now, what we're doing is we're raising rents from that 4 to 6% figure. And what's been wild about that is, I mean, this, the last time inflation has been this high, we've had rents have gone up 10% year over year for the decade of the 1975 to 1984. Right. And that is one of the powerful, pieces, is that while, yes, interest rates are higher, but hey, we have this inflation, and what goes up with inflation? Rents do. And that's just absolutely powerful. So how long will we be able to raise rents at that 6 to 10% figure? Well, that all depends on how much this inflation and how long it's going to be here, which I think is going to be here for a while.
And that's 100% my point, because rates went up, other things go up, right? So the rents that you're getting every single year will continue to go up. But what's really cool about that is the cost of your loan continues to stay flat. That doesn't go up. So let's look at a couple of things before we really get into the numbers here. I'm going to do a quick share screen if my system wants to play. Here we go. So we're going to look at this real quick. I'm looking at the CPI. Now, the red line represents the CPI as it is today, and the CPI is the consumer price index. That's what everybody's looking at for inflation. Now, when you look at the Dow and the NYSE and the NASDAQ, none of them equal the same, right? They're all different numbers when you look at the value of that index. Am I correct, Mark?
That's correct.
Okay, and the reason being because they stack different stocks in there to come up with what that index is. The same as the CPI, the Consumer Price Index, is an index of specific items that the Federal Reserve tracks to come up with an actual value of inflation, depending upon what those are doing. Not all the things we spend money on, only specific things. And all those things, interestingly enough, can be manipulated with monetary policy. So you look at the blue line, that factors in a lot of those other things they used to factor in way back here in the 80s. And I'm showing you where my cursor is. Right there. Way back in the 80s, they just look at everything. Now they don't look at it as much because they want to make it look like everything's getting better. But when in reality, our cost of living continues to go up, while they're showing it's going down because they're manipulating certain things. Now, it's important for us to look at this because as Mark alluded to earlier, our inflation is higher than it's been in the last 40 years. The last time it was remotely as high was in the 1980s. Well, let's see what the interest rate was in the 1980s. This is the rate for people buying homes to live in. We were at 19%, 18 to 19%. But it's come down from there, but you can still see double digits all the way up to 1990. We have all these double-digit interest rates. Even though inflation, if you go back here, inflation in the 90s looked to be really low, but look at where the interest rates were at that time. They are actually pretty dang high. So if you take that into consideration, where we are right now with inflation, our rates should be a hell of a lot higher than they are today. So what I'm telling everybody is you need to at least wrap your brain around the fact that we're getting a gift at this point. where interest rates are today, we're still well below the double digits, but our inflation is high enough that we should be well in the double digits, approaching 20% on our interest rates, especially for investors. The other thing that we want to look at is the federal fund rate. The federal fund rate, right? Actually, this is not the updated version. I had an updated version here on a different one. It's actually 2.5 right now. As of a couple of months ago, it was 1.75. They raised the federal fund rate by 0.75%. This should read 2.5. But the federal fund rate back in the 80s, when our inflation was high as it was here, we were 20% in many cases. If you actually go back and look at the chart and see how Paul Volcker raised those rates, you'll see them ranging from anywhere from 16 to 20%. That's why you're seeing this thing not peaking quite at 20 because they were dropping it down quickly. You would see a 4% swing every time the Fed would meet. That's a pretty big dang deal to have that kind of a swing. It's kind of painful. So the reason we bring that up is so people would understand what we could be at and what we're really not at. So that right there is a big deal. So another thing I'm going to share with you.
Well, and before you move to the next point, I mean, that's very well said. Like you said, today's rates are a gift compared to where we have been in the past in a similar economic environment. And I think it's really interesting because I'll talk to the investors that we just met over the last year. They got in during COVID, interest rates were at historical lows. And now they look at interest rates, being higher, and they say, well, this is worse than it was last year. Why would I buy rental properties now? And then you have the conversation with the guys that have been investing for decades, and they're doing a $5 million refinance and own 180 properties, and they're buying as many properties as they can right now because they understand that it's not about the interest rate today, the cash flow today. It's about long-term generational wealth, financial freedom. I mean, the whole goal is, how do you think this portfolio is going to perform in 20 years, right? And if you don't get started now, well, then where else are you going to, put that money at the end of the day? And that's the fun.
Well, you can't keep it in your bank account because it's losing money at such a rapid pace. I mean, you have it sitting in a checking or even a savings account at not making 1%, but inflation's eroding it at over. Even we just went with the Fed's numbers, 8.5%. Right, so it's a losing proposition to hold on to cash. You've got to put it somewhere and let it grow. So we do know because of inflation, you get an appreciation in the property. You get increasing rents, and we'll get into those numbers here in a bit. But let me ask this question of you. Well, before we get into the question, I'm going to share one more thing with you guys. I'm going to share with you the history of actual rates. And so this has 2,695 lines showing the history of the interest rates. I'll get you deep in here, and you can take a look at some of these interest rates here. Let me see here. I'm still in the 90s on this. Now we're getting into the 80s. Look at all these double-digit rates in the 80s. Interest rates of 13%, 14%, 15%. We're seeing 18 in plenty of these spots.
Yeah, I remember when Jim Reedy said they threw a party back in the 80s when interest rates went below 10. And imagine if you called someone and they're like, hey, interest rates are 10. Do you want to lock today? People would freak out. It's just so interesting.
Lose it. I'm surprised we're not there. Right. So the reason I share this with you is I want you to see what has happened with rates. So we were showing 18s. Now we're showing down to 7s, 8s.
Such a big file, it's laggy.
Yeah, I'm touching it too much, so it's popping up windows and stuff. So, and it's such a big file. There's 2,600 lines here, I think is what I said. Yep, 2,600 lines is what we're getting into. So 2,695 lines. Now, what I did is I averaged this out. So if you go back from 1971 to 2022, tracking the 30-year fixed mortgage for people buying houses to live in, the average interest rate right here is 7.769. So it's basically 7.7% was the average interest rate from 1971 to now for people buying houses to live in. Now, the average rate up until quantitative easing. Quantitative easing started in 2009 when we had the crash of 2008. The Federal Reserve took and put $1 trillion into the mortgage-backed securities markets from January 1 of 2009 to the end of March 2010. 1 year and 3 months, $1 trillion. We've talked about that at some of the MIP events in person. So that $1 trillion where that started, if you look at the average rates from 1971 to 2009, before the Fed got involved and started messing with things, 9.11% is what the average interest rate was up to that point. And that, again, was for owner-occupied mortgages. Then you get into 2009 when you had the quantitative easing starting from 2009 till now. is an average rate of 4%. Now, when you take the pandemic, you take the virus gets released from China, changes the world, right? The Federal Reserve goes and basically turbocharges their investment into the mortgage-backed securities, dropping in 1 trillion. Remember before we said $1 trillion from January 9th, 2010, January 2009 to the end of March 2010. 1 year and 3 months, $1 trillion. Actually, it's 1.25 trillion. Now that I remember, 1.25 trillion. Well, from March 20th of 2020 till March 30th, 2020, they dropped in $1 trillion in 10 days. Then they continue to drop in billions upon billions of dollars into the markets, giving us an average interest rate from that time, March of 2020 till now, of 3.3%. If you back out the Fed's quantitative easing and their involvement and start dumping printed capital into the markets to drive down interest rates, we would be an average of 9+%. Just the way it would be. We may be a little bit lower than that because things were a little lower before the Fed started getting involved, but we're still looking at probably 8 to 9%. That would be the average. So again, regardless of anything, just looking at history, today is a gift, an absolute gift when it comes to the interest rates. And if a person wants that chart, I'd be more than happy to provide it to you. It's locked. You can see it. That way, if you touch something, you don't know how to put it back, I locked the whole thing. You guys can see all these interest rates that we researched. So here's another thing that I want to get into real quick. Who benefits when interest rate is the most important thing, Mark?
Who benefits when interest rates are the most important? What do you mean by most important?
Well, when an investor is looking to buy a property and the most important thing to them is getting the best interest rate, who benefits by that thinking?
Who benefits by that thinking? That's probably the lender.
100% the lender. And some people might think, well, why would the lender benefit if they're shopping around to get the best interest rate? It doesn't make sense that the lender would benefit. Because if you can program them to think interest rates are what it's all about, then it's easy to convince them to refinance their home. So who, and Mark, have you, I'm asking everybody else to ask that question for themselves, but who's looked at an amortization table on a 30-year fixed loan?
I hope everyone here, and if you haven't, you should.
You should, especially the first 5 years, because it's mostly interest. And let me show you. Right here.
Yep, exactly.
Right here what I'm looking at. So we have a loan where a guy had $120,000 balance on his home. And it was a 30-year loan. He had paid on that for 4 years and then comes to us, hey, I want to refinance. So he wants to do this refinance. He started at $120,000. By 48 months later, he owed $113,537. So he'd only paid the principal down by $6,462. That's it. Well, the amount of payments, though, when he made over this period of time, $719.46. When you add that up over 48 months, it was $34,534 that he paid out over that period of time. So he paid out over almost $35,000, but his principal down just went down by a little over $6,000. Who won in that situation?
Well, now the lender, because that's why they send mailers every 5 years to get you to do the refi.
Exactly. The lender's killing it. Literally, they're just making interest. That's it. Well, we couldn't convince him to not do that. He decided he had to do it. So I'm going to show you the math real quick. This is the math I showed you. If you want to pause, take a look at it. Here's the actual calculations. So you can pause it and take a look at it. But this was the deal we did for him. I tried to talk him out of it. When it's extremely busy and people want to refi, I spend an enormous amount of time telling them, you're wasting money by doing this. Again, he started with a $120,000 loan. By the time we got the payoff on his loan, we had the prepaid items, which is taxes and insurance. We had the closing costs associated with the loan, lender, title, appraisal, inspections, all those kind of things. I guess no inspections, but lender, appraisal, and title.
Sure.
Took those and added them on the loan, which is what everybody does. Look at his new loan amount, $119,833. It was $166 and change, $166.04 away from his original loan amount.
It's a waste of 5 years of payments.
100% waste, because you just put it all back into this. And then if he got into the habit, which is the habit they're hoping for, is to get people into the habit of continuing to refinance it every few years. 20 years from now, where's he at? He owes exactly where he started at 20 years before. But the guy down the street who's been making his payments, who had bought it at the exact same time with the same loan amount, the same interest rate, made his payments over that time period, he's almost done. He's a third of the way done. So what's also sexier about this is not so much just what is done as far as the him paying off the house. It's what did he actually pay? So let's take a look at this real quick here. I'm going to get a different, actually, no, I'll just use this. It's a different numbers, but we're going to go with these numbers because this was an actual deal we were working on at the time I put this together. So here's an individual that has a loan, $147,300 purchase price, 20% down with $117,840 loan amount. Now, interest rates reached 7% this year. They're not there anymore, right? We're way off of that. We're in the low sixes now, but it peaked at 7%. Now, when you looked at this, the payments that this person was making was going to equal $283,237 over the entire life of the loan. He borrowed 117, but he's paying 282,000. Isn't that a little daunting? Some people are like, this is stupid. Why should I be doing this? But what's inflation doing to the dollar you're making payments to the lender? It's declining every time you make the payment, right? So when we recalculate all of this over that 30 years, and I'm just using an 8% inflation, because if you look back at those charts I was showing you before, we've been over 8% inflation for a long time. It's longer than 2012 when you look at the real rate of inflation. But the dollar is losing that much value every single month or every single year. And at 8% inflation, the dollar is losing at least 0.666% of its value every single month. So if you borrowed it today, bought an asset at today's dollar value, and started paying it back slowly like this, and you recalculate every dollar that leaves your hands compared to the value the day you borrowed it, this guy's only paying back $106,845. That's it.
Everyone needs to take a screenshot of this photo right here, because that inflation adjusted payment is just one of the most powerful values and pillars of owning real estate, because as inflation goes up, as rents go up, your inflation adjusted payment goes down, and that spread is yours.
Yes, it belongs to you. Plus your value goes up on your house. Plus you're writing things off on your taxes that your tenant's the one paying it. Well, take a look at this. We just put this at a 3% increase in rents, right? He started at $1,185 a month rent. This is a real deal, right? He financed $117,000, got $1,185. He was at a just over a 1% rent to loan ratio. He was well below a 1% rent to value ratio, which is a lot of people are kind of freaking out about that. But it's just over the 1% rent to loan ratio. Well, if he's making a 3% increase every year on that base rent of $1,185, look what his total income was, $665,000 on this house. That's the income. That's not the appreciation. That's not the tax benefits. That's the income. But you're only paying out $282,000 of those actual dollars, but the value of those dollars you gave up was $106,000. What if you reinvested the $665 or whatever it was you were getting as far as the cash flow? Where's that going for you now? You can start seeing the possibilities, right?
Compounding on that, powerful. Yep.
100% compounding growth, right? Now,
so my question to you here is still saying, okay, hey, rates go down. Let's not do a refinance. When do you think it is recommended to do a refinance, if ever?
I love doing the refinance when I get cash back out and put it to work in the market.
There you go.
There's no reason, in my opinion,
cash out refinance, pull out enough capital to actually go double the size of your portfolio, right? You have one house,
or get another property, right? If you refinance one house and you get enough to buy another house, you just doubled your assets within that one, and it cost you nothing. Sure, you had to pay fees, but who's paying those back anyway? It's your tenant, right? And you just doubled your asset base as a result of it, based on that one refi for one purchase. It didn't cost you anything. That's not your money. That's the lender's money. They're the ones who are putting that up, and they're the ones losing money because they gave it to you. You're the one making money because they gave it to you. The other cool thing here, you mentioned people take a screenshot of this. Yes, take a screenshot of it. We don't need to. And here's why. Because you just get your QR code out, or get your phone out, get your camera up, take a picture of this QR code. Take that. And the reason being, some people may not be thinking, well, why am I going to do that? I don't want to clutter up my phone with QR codes. Well, here's why. We'll go through this first, and then we'll come back. So you're going to get this thing right here called the QJO investment tool. Why is it called that? Because I named it that. I named it the Quit Jerking Off investment tool, because that's what people are doing when you're so worried about rates and what's my cash on cash return and all this kind of stuff. You're missing all the other things. And the reason I made this tool is to help people be able to see how inflation is affecting you. This is the tool you will get. Now, he's going to ask you for your name, your email address, your phone number. Give me the information. Don't put fake crap in there, because I'm going to update this. I'm going to make it better and more hot rodded. I've already got the plans, some cool stuff. I'm not going to tell you what we're doing, but it's going to be some cool stuff that you're going to get those updates when we do that. So here, let's just use the calculator real quick. Go to the mortgage amortization schedule, please. And you're going to click on that. And it's going to open up that calculator. You're going to put in, just to check it, make sure it's working the same as what I have. You're going to type in 20% for down payment, 150,000 for a purchase price. And we're going to put in 7% interest rate because we shouldn't be scared of rate. And then you're going to calculate this thing. And then you're going to see the principal and the interest. You're going to scroll down to the bottom. You're going to see the total payments to date, and then the loan balance, which is, that's the balance that went down after one payment. And then you're going to go up to the right, and you're going to click on this calendar icon. And you're going to see every year for 30 years. And you're going to scroll far to the right to 30 years from now, hit select and close, and you're going to see the total payments you'll make, the zero balance. And this is what inflation did to those payments. $98,050. You paid $259,000, but it's worth 98. Now this is set at 8% inflation. The updated versions, you can be able to set the inflation yourself. There's going to be a lot more other cool things you can do. Another interesting thought here is the difference between the dollar now and the dollar and 30 years from now and what that looks like. Let me explain how that shows. You can buy $65 worth of stuff, as this is evidencing right now today, but in 30 years, it's going to cost you $719. That's what 8% inflation does to goods. So you can understand what we're up against here. So if you didn't get it, here's your chance at getting it again. Go ahead and just click on that, get your QR code, download this. It's a tool for you. There's other tools on there. You can calculate your Schedule E income off of it. You can calculate your reserves that you need to buy more property. And if you get them, you're not sure how to use them, just reach out to me. Here's the ways to get a hold of me. Just go to aaronbchapman.com or aaronchapman.com or search for Aaron Chapman, look for the bald bearded redneck, and then make an appointment to talk. I'll walk you through it. The bottom line here is I absolutely need you to be successful in your real estate investment venture, because if you become a failure, I become a failure, and I'm very violent against failure.
Well said. Well said. Well, hey, I just got the Quit Jerking Off app, filled it out. Literally took, well, that took 5 seconds just to send it off. That's a great little product that you have there. But man, I mean, I love what you said about let's look at the past to figure out where we are and how lucky we are for the present. And just to be able to go and show and realize that the rates that we have today are a gift. But once again, if you're fixated on rates, you're already behind, right? You're already losing at the end of the day, because the focus is on how is this portfolio performing in 30 years, right? And that is the long-term vision, the long-term goal. To, like he said, you can do a cash out refinance to be able to buy more properties, but don't do it just to be able to adjust your rates, because then you're just paying interest the entire time.
100%. And don't get caught up in the cash on cash return, especially that first year, first couple, 2 or 3 years. In fact, one thing that it's failed to be looked at is what happens just on the amortization of the loan. Just another quick math equation. You guys get your calculators out and test my math here. But if you bought a house for $100,000 and you put 20% down, you would invest $20,000 of your money. You would get a loan for $80,000. And if you did your job as a real estate investor, as I said before, is pick the right people, get the property you can keep reasonably rented for the entire time you own it, you can raise rents on. We know the tenant pays off that $80,000. So take the $80,000 on your calculator and divide it by 30, because that's how many years it takes to pay that off. You will find that the sum that you end up with is $2,666.67. That means every year, averaged over 30 years, that tenant is paying it down by $2,666.67. That means your 20% or your $20,000 grows by $2,666.67 averaged over 30 years. Now, you get that figure, hit the divide button. So $2,666.67, hit divide. Now type in your investment, $20,000. Then hit the equal sign. You will figure out that is growing by 13.33% per year. Your money's growing by 13.33%. It doesn't do that anywhere else. And that's predictable, provided you do your job. Some people will right now be saying, whoa, wait a minute, I pay closing costs. Okay, let's add $6,000 to that number. Instead of taking the 26,666.67 and dividing into 20, divide it into 26,000. You'll find that's a 10.2% increase in your initial investment year over year, before cash flow, before rent raises, before the inflation we just talked about, all of that. If you can find 10.2% religiously without all those other things, you're still kicking ass. I'm telling you, you're getting it, and all this gravy too. So don't forget those things. Don't forget that real estate makes well, residential real estate makes geniuses out of all of us eventually.
So I absolutely love the math that you just did there. If that doesn't make any sense, please reach out to us to let us, elaborate on that. And let me ask you this, that 10 to 13%, let's do 10% because it's more conservative. Is that factoring in the interest rate? Does it matter if you have a 10% interest rate or a 2% interest rate? Are you still getting a 10% return on your money year over year?
Your initial investment is growing by 10.2% regardless of what the rate is. Doesn't freaking matter.
Regardless of the rate. That's key. And I always like to say, what's the worst case scenario? What's the rock bottom? And that's exactly what it is right there. That is the number one powerful benefit of using leverage, investing in real estate, because that's worst case scenario. And if you look at all the charts, historically speaking, we can consistently say, confidently say, rents are going to go up with inflation, and same with values that go up. But even if they didn't, I'd take a 10% return. I mean, that's powerful. And that is the average of the S&P 500 after tax. So that's one of the big benefits of owning real estate, but also having leverage, but smart leverage with the right people, have the right team, find people that are actually experts that focus on turnkey investor loans, because they're different than the primary loans. That individual that got you the loan so you could buy your very first home to live in, it's not the same type of product. You need to have someone who's a special T at it. And that's exactly who you get with Aaron Chapman, Security National.
Right on, brother. Well, I appreciate you allowing me to take the time, and I appreciate you guys for paying attention, listening, and let me spout off and throw numbers at you. Slow it down if you need to. Reach out to me. I'd love to just share all the data with you. And thanks for getting the app. It's only going to help.
Thanks, Aaron. All right, for everyone out there on the SOFA Summit, hope you found a bunch of value. If you need Aaron's contact information, we will add that here so you can reach out to him. Please give him a call. He's on the phone all day, every day, talking about the pros, the cons, where we're at in the market. Highly recommend joining his YouTube channel. He posts 2 videos every single week that are extremely valuable. I watch them every single week. That'll educate you so you can have immediate access to data and facts and make informed decisions, because that's what it's all about here at the SOFA Summit, being educated so we can make smart, informed decisions. So that's it for this session. We'll see you here and right after for the next one. See you soon. Bye, Aaron.
Everybody.